The last thing to cover on guidance is our stock-based compensation expense, which we currently forecast to be between $80 and $85 million in Q1 and $340 million for the full year.
Everyone wants Kobe and Michael on the team, but no one wants to pay Kobe and Michael. If you've ever invested in popular tech stocks, you might be familiar with how these companies use their own stocks to pay their workers. They call this share-based compensation. This could incentivize long-term employee retention for a company because the better the company does, the more potential money one can make. Also, it's important to note that there is usually a vesting period of a few years before one can sell their shares. Massive companies like Amazon also do this. After 2 years of working for Amazon, you're able to receive and increase an RSU, which is basically compensation to an employee in the form of company stock. Taking a look at how high gas prices are nowadays, we think companies should also give out gas station gift cards as a form of compensation. Just a short time ago, SoFi released its 2021 operation results. About $239.37 million were spent on SoFi just to keep the fire burning. What do share-based compensations mean for you as an investor, and what are the odds SoFi is taking the same position as the whole industry? Make sure to watch until the very end of this video to find out. But wait, before we start, if you're a true SoFian soldier like us, feel free to check out the SoFi Investors Facebook group, which will be in the description box below. We're building an army. You can also find us on any other social media platform at WealthGAMBIT. Follow us there to stay updated from SoFi to general stock market updates and some dank financial memes. We have it all. Also, we're not financial advisors and none of this is financial advice. Always do your own due diligence, aka doo-doo. All right, let's get into it. We know you think $80 to $85 million worth of stock can seem like a lot. And I mean, to be fair, that is about 25% of the expected revenue in the first quarter of the year. Whoever said keep your friends close, but keep your enemies closer, kudos to you, man. But let's see the real deal with the other contenders in the fintech space. Lending Club reported a total of $69.67 million worth of share-based compensation expenses. It's about 8.5% of the company's net revenue of $818 million. And it's on top of the fact that the tables have turned and Lending Club's actually realizing net income this year compared to a huge loss of about $187.53 million last year. And to think that it happened after getting the bank charter approval. Are you thinking what we're thinking? Apparently, too much of this may be getting a little serious for investors of the company, as share-based compensation might seem just like a normal payout or expense of the company, but this is just another hidden culprit in the dilution of shares, making returns to be less valuable than it seems in one look. When evaluating stock-based compensation, or anything for that matter, it's best to look at the whole picture instead of jumping to conclusions. For example, if you see someone flexing a new Lamborghini on Instagram, that doesn't necessarily mean they are rich. They could be living in their mom's basement and have spent their entire life savings to rent that car for just one day and look like a big baller shot caller. But anyways, let's take a look at another giant in the fintech space, Square. 3 years since Square's last net loss, this fintech is overly invested in share-based compensation expenses as well. Amounting to about $608 million in 2021, this company nearly increased the share-based compensation by about 53% since last year. What's the true cost of share-based compensation expenses though? Earlier, we said that companies use this for incentivizing employees and making them feel like they hold a real ownership stake in the company itself. According to sources, stock-based employee compensation hurts net income by being an expense, but the panic lies in the fact that the companies add this back to the earnings because of the illusion that it's non-cash and it's a non-recurring expense, so that they might be able to get a higher EBITDA, causing the company's valuation to be a little overvalued. But Grandpa Buffett said, if options aren't a form of compensation, what are they? If compensation isn't an expense, what is it? And if expenses should not go into the calculation of earnings, where in the world should they go? So when investors hear the word stock-based compensation expense, it's actually a mood killer, especially when it's increasing significantly. Perhaps you're a little worried about it in SoFi's case, but don't worry, we have some juicy info that can help you sleep much better at night. For 2021, SoFi incurred a total of $239.37 million of stock-based compensation expenses, which is approximately a 137.5% increase from last year. But here's the catch. SoFi got the most awaited bank charter earlier this year, and according to Captain Noto, SoFi Bank will start taking effect on their operations in the second quarter of this year. Quote, that's because, as I just mentioned, we opened the bank with no loans and initially capitalized it with cash from our balance balance sheet. This is an important distinction because we won't begin to realize the lower cost of capital benefits of the bank until we can originate and fund loans in the bank. And we believe it will take until Q2 to build the appropriate loan balances to see more than a nominal impact. A lot of people say companies use stock-based compensation expenses when they have cash problems. Now this makes a lot of sense considering SoFi had to use a lot of cash to fund SoFi Bank, and inevitably SoFi had to lean on another kind of strategy to carry out its plans. That strategy may have just been stock-based compensation to pay the ones who have made SoFi what it is today. It's surely not pleasing to the eyes when you see companies low on cash, but SoFi seems to have a valid excuse. Sooner or later, we're going to see how all of this will fall right into place and whether or not Captain Noto is a man of his word or the other way around. Anyways, that wraps up today's video, guys. We hope you got some valuable nuggets from this video. The stock-based compensation does seem a little high, but considering the raw talent SoFi has and the fact that the stock-based compensation incentivizes employee retention, it doesn't seem too bad in our opinion. Obviously, we would like to see that number go down over the up and coming years, so we'll be keeping a close eye on SoFi stock-based comp. Let us know your thoughts in the comment section down below, and until next time, peace.